Welcome to the Deep Dive. We're here to give you that analytical shortcut, cutting through the noise on market moves that just don't seem to add up.
Yeah, and today we're really getting into one of those, Laird Superfood, LSF, their Q2 fiscal 25 earnings call.
Right. And this one's crucial because, well, you saw this huge disconnect, didn't you? Management sounded incredibly confident, almost bullish.
Totally bullish, talking up momentum, hitting profitability goals, you name it.
But then the market just hammered the stock. What was it, down over 15%?
15.4% pretty much straight away after the call, a really sharp drop.
So that's our mission today. We need to unpack that. Why did a call that management framed as, a positive step towards profit get such a negative reaction?
We've got to look beyond the headlines, I think.
Yeah.
Really scrutinize the results, the quality of the revenue, and maybe the risks baked into their outlook.
Okay, let's start with the results themselves. It was definitely a bit of a mixed picture, wasn't it?
It was, though, arguably tilted positive on the bottom line.
Yeah, the positive side first. They beat on GAAP EPS by 3 cents. Came in at -3 cents when the street expected -6.
And maybe more importantly, that adjusted EBITDA number came in positive, about $0.1 million.
Which keeps them on track, or so they say, for that full-year break-even goal. That's progress.
Definitely progress on costs and profit, can't deny that. But the top line, the revenue, that's where the first bit of friction seems to have come in.
Right. Net sales were $12 million. Just slightly missed the consensus, which was, what, $12.13 million?
Yeah, a narrow miss. And look, 20% year-over-year growth is still pretty strong, especially now.
Sure, in this environment, absolutely.
But for a stock like LSF, priced for really high growth, even a small miss like that, it immediately makes people nervous about the future, the long-term path.
And you think that's what caused the sell-off, that tiny revenue miss?
I think that plus the implications for the rest of the year, yeah. The market basically said, okay, nice job on costs, but we're worried about the sales ramp you need later, and it punished the stock.
Signaling that right now, consistent revenue growth matters more than just hitting marginal profitability. Quality over quantity, maybe.
Exactly, which, brings us nicely to where that revenue is coming from, because there's a big strategic shift happening.
The move to wholesale.
Yeah, it's accelerating big time.
The numbers really show that, don't they?
Yeah.
Wholesale sales jumped. What was it?
47% year over year. It's huge.
Wow. So that's now nearly half their business.
48% of total net sales, yeah. So they're pushing to retail stores, physical distribution. It looks like it's working.
It certainly seems to be paying off in terms of volume.
It does. But here's the flip side, and maybe where some skepticism creeps in. E-commerce growth basically stalled.
Stalled? How much growth?
Just 2% year over year. So the other 52% of the business, the direct consumer part that often has better margins, it's barely moving. Seems like Amazon is carrying most of that weight.
Okay, wait. If wholesale is surging like that, up 47%, doesn't that usually mean more trade spending? Slotting fees, lower prices per unit?
Typically, yes.
So how did they keep their gross margin so high? It was, what, almost 40%?
39.9%, which is, frankly, fantastic.
Fantastic, yeah. But how? If they're shifting to lower margin wholesale and not raising prices, that seems difficult.
That's the core question, right? And management's answer, their big talking point on the call, is that they haven't taken any pricing actions. None.
Seriously. With inflation in coffee, coconuts, tariffs.
All that.
They claim they're absorbing it all. Plus the higher trade spend from wholesale. They say it's all down to operational efficiencies.
Like what kind of efficiencies?
Things like sourcing ingredients directly, optimizing shipping routes, basically trying to squeeze costs out of the supply chain to offset everything else.
Huh. That's aggressive. So they're basically betting they can gain market share by not raising prices, keeping consumers happy, and hoping the cost savings keep margins up. That seems to be the strategy. Protect the consumer, gain share, and hope scale efficiencies cover the costs. They see it as an advantage right now.
But it's risky. What happens if commodity prices spike again, or those efficiencies slow down? That 39.9% margin could be vulnerable.
Absolutely. It's a tightrope walk. Which brings us to the guidance, the forward look, and this is probably where a lot of the investor concern really solidified.
They reiterated their full-year guidance for fiscal 25, right? Still aiming for 20 to 25% net sales growth?
They did, and achieving break-even adjusted EBITDA for the full year. Very confident reaffirmation.
Okay, but hitting that sales number requires, a really big acceleration in the second half of the year, doesn't it? Q3 and Q4 have to be significantly better than Q1 and
A
Q2.
very strong ramp, yes. And they got pushed on that in the Q&A. How credible is that acceleration?
And what was their explanation?
They pointed to two main things that held them back in the first half. Specific sort of one-off issues.
Okay, like what?
First, they said they had a big out-of-stock problem in Q1, mostly with their powder creamers. They put a number on it, too. Said it cost them over $1 million in sales.
Over $1 million. That's substantial. Okay, what was the second thing?
The UNFI cyber attack in Q2, remember that? It apparently hit their distribution temporarily, cost them maybe 8 to 10 retail points for a while. They estimated a few $100,000 in lost sales from that.
Ah, okay, so temporary identifiable issues.
Right, so management's argument is fix those temporary problems, plus layer in the new distribution wins they've already secured.
Like the club store expansions, getting into more Safeways and Albertsons.
Exactly. They believe those gains will kick in properly in Q3 and Q4 and drive the needed acceleration. That's the logic.
And they have the cash to support this, because growth costs money.
Well, they expect to use about $2 million in cash from operations for the full year, but they have $4.2 million in cash on hand and, importantly, no debt.
So they have some cushion.
They do. And interestingly, they specifically said they're using some of that cash strategically right now to build up inventory.
Why? To avoid repeating the Q1 stockouts.
Partly that, yes, to support the growth they expect. But also, they mentioned mitigating supply chain risks, specifically citing potential tariffs on stuff coming from Southeast Asia.
Proactive. So they're spending cash now to hopefully ensure they can deliver in Q3 and Q4 without supply hiccups.
It's definitely a sign of confidence in their forecasts. They're willing to burn a bit of cash now to de-risk the execution later.
Okay, confidence is one thing, but execution also needs products. What about innovation? Any catalysts coming down the pipeline?
Yeah, they talked quite a bit about innovation, particularly focusing on fixing things that maybe haven't worked perfectly before, like liquid creamers.
What's the plan there?
A major overhaul. They called it a super optimized formula, moving to organic certification, using only coconut cream, getting rid of gums and coconut oil, and switching to coconut sugar.
Sounds cleaner.
Yeah.
But you mentioned fixing things.
Right, the packaging. This was interesting. They're moving to a post-recycled plastic bottle.
Plastic? I thought they used those paper cartons.
They did, but they admitted on the call that those paper cartons are actually really hard to recycle effectively in the U.S. So the consumer thought they were being eco-friendly, but the packaging often ended up in landfill anyway.
Oh, wow. So the plastic is actually more recyclable in practice.
Apparently so, in the current U.S. system. It fixes that disconnect between perception and reality for the consumer. A smart logistical fix, really.
Okay, that makes sense. Anything else new?
Yes, and this one's a pretty big departure for them. They're launching their first dairy product.
Dairy. From Laird Superfood, the plant-based guys.
Exactly. It's a protein-based coffee product. They're betting they can use functional mushrooms and source cleaner, maybe organic dairy, to play in what they called a very hot category.
Like those ready-to-drink protein coffees that are everywhere.
Pretty much. It's a risk, moving away from their plant-based roots. But they clearly see a big opportunity there and think their brand's focus on functional energy can stretch to include dairy. High risk, potentially high reward.
Okay, so summing that up, they say they've identified and fixed the Q1, Q2 problems. Margins are holding up surprisingly well. There's innovation coming. So why, again, did the market react so badly? Down 15%.
I think it boils down to execution risk and maybe the quality of the growth mix. Meaning that stalled 2% Q-commerce growth is a flashing light for some investors. It suggests that channel might be tapped out, at least for now.
So they have to rely on the wholesale channel for growth.
Pretty much. And like you said earlier, wholesale usually means higher costs, more trade spend, potentially lower margins long term.
Right. So the skepticism is, can those operational savings really keep offsetting those pressures and absorb commodity inflation and tariffs indefinitely, especially if wholesale becomes, say, 60 or 70% of the business?
Exactly. Investors are looking at the slight revenue miss, the slow e-com channel, and thinking, is this growth story really as durable as management claims? Especially given the big ramp needed in the second half, it feels fragile to them.
It's a prove-it situation, though.
Totally. The market's basically saying, we hear your explanations for Q1 and Q2, but we need to see the numbers in Q3 before we believe the full year plan. If they don't deliver that acceleration, the stock could struggle.
Which leads us perfectly into our final segment. Time for a thought experiment.
And let's be crystal clear. This is absolutely not financial advice.
Nope. just an outrageous but maybe plausible trade idea
Yeah.
based purely on what we've just discussed here in this deep dive.
Okay, so the core idea, the thesis, is that the market just completely overshot to the downside, that 15.4% drop. Maybe it was an overreaction to problems that management actually quantified and says are temporary.
The million plus from the stockouts, the few 100,000 from the UNFI issue.
Right. Those are fixable, potentially non-recurring headwinds. So the sell-off maybe didn't fully factor in that these specific drags on revenue should theoretically disappear in the second half.
Okay, so the trade idea would be
You could argue for taking a high conviction long position right after that big drop, maybe around that $6.04 low point.
betting that management is right, that those Q1, Q2 issues were temporary and the recovery is coming.
Essentially, yes. It's a bet on the credibility of that reaffirmed guidance. You're basically buying the stock at a price that seems to ignore the potential for that second half acceleration, a price that discounts the whole recovery story.
And the potential upside.
Well, you look at the analysts who cover the stock, many still have buy ratings, price targets up around $12. Now those targets depend on execution.
Of course.
But if LSF pulls it off, if they hit even the low end of their 20% growth guidance and prove the margins are sustainable, getting back towards that $12 level implies, well, almost double your money from that $6 entry point. High risk, high potential reward. Contrarian.
A very contrarian play, betting against that immediate market reaction. Okay, let's quickly wrap up the key takeaways from this deep dive.
Laird Superfood is pushing hard into wholesale, and it's driving top-line growth. Impressively, they've maintained strong gross margins so far without raising prices, relying on efficiencies.
But the big challenge, the thing everyone's watching, is execution. They absolutely need that strong acceleration in Q3 and Q4 to hit their reaffirmed full-year targets.
Which leaves us with that final provocative thought for you, the listener, to chew on.
Go ahead.
Laird made a very deliberate choice. Absorb inflation, absorb tariffs, don't raise prices, protect the consumer, build trust, gain share. The question is, can they really keep doing that forever just through operational savings, especially if growth eventually slows down?
Or is a price increase basically inevitable down the road, maybe in fiscal 2026,
Yeah.
potentially risking some of that margin discipline they've fought so hard for?
Exactly. Can the no price increases strategy hold long-term in this kind of environment?
A classic dilemma for brands right now. We'll definitely be keeping an eye on their next quarter's results. Thanks for joining us for this deep dive.